Welcome, Science with JCL. Pleased to have you with me today. Thanks for taking time out of your day and to look at Antero Resources. This is ticker symbol AR. Now we're going to start out by just understanding what they do. So according to the Simply Wall Street profile, Antero Resources Corporation is an independent oil and natural gas company. Got quite a lot of proven reserves. They were founded in 2002. Now that we have that context, let's have a look at 10-year financial history. So the trend of revenue, first of all, is increasing over the period of time, from less than $200 billion 10 years ago, all the way up to $3.5 billion for the most recent 12-month. Now, the net income, as is often the case with oil and gas companies, does fluctuate significantly. That's quite linked to the price, of which they don't necessarily have direct control. That price fluctuates. That's therefore the earnings per share will be up and down a bit. And it does make it quite difficult, if you don't understand these companies in detail, to actually predict what their earnings are going to do. Now, what we can see is the number of shares increase a little. 2017, and it has decreased. So they've been doing some share buybacks over the last couple of years, which suggests that management think their shares are cheap or cheaper than they should be. And book value per share, we have seen that increase to around about $25 and just tail back a little bit down to $19.45. Keep that figure in mind, it's going to be quite pertinent later on. Now, they do generate quite a bit of free cash flow. It's been positive for a long period of time. And for the most recent period, that free cash flow has been approximately $1 billion. Again, let's keep that figure in mind because we'll use that a bit later on. Now, we talked about margins and therefore return on equity is going to be quite fluctuating. There's not too much to say on the profitability side. If we have a look at the financial health, that current ratio is quite variable and pretty low at 0.48. The debt to equity is below 1, so that's okay. Not amazing, but it's all right. So that's a 10-year history. It looks like a reasonably typical sort of oil and gas company. Now, first of all, Simply Wall Street is saying they're 41.6% undervalued. Now, not necessarily to take this as gospel, this is just an indication. Have a look at their revenue, earnings, and free cash flow. See that there's potential increase in the next few years on earnings and free cash flow compared to the current value. It looks like in the short term there's a bit of upside there. See here the debt history in graphical form. That debt has been sort of tailing off over recent quarters, which is excellent news. And the management team, you can see here, the CEO has been with the company for 17 years. So that is fantastic news. So he knows the company inside out and is very experienced in the industry. So we should take this as positive. Okay, we have a look at the ownership breakdown. Insiders still own over 7% of the company, which at this stage for a company that's almost 20 years old is quite unusual. So again, that is a good sign. They do have skin in the game. It's news. You can see here the CEO owns 4% of the company with a valuation there of over $100 billion. So he is definitely well bought in and linked to the success of the company. Now, I can hook you up with a free budget spreadsheet if you were to join the Patreon group as a VIP supporter. I'd like to give a shout out to our contributor on Patreon. We have share discussions, my wish list is posted, you've got direct access to me. As I say, I can hook you up with my budget spreadsheet, which you'd normally have to buy otherwise. If that's of interest to you, I really appreciate you taking a look via the Patreon link in the description below. Okay, so back to it. We'll have a look at Yahoo. Let's have a look at that price period. So they were trading at $21, $22. If you go out even further, they peaked at 65, 66 back in 2014. And it's pretty much been on a downward trend up until April last year. They were down below $1 per share. I mean, that is incredible. You don't see that very often. So they've lost almost 100% of their value there. and it has now crept up to 9. So if you were brave and you bought below $1, you're up to 9. That's an insane increase. And they have actually released some earnings information recently. And we can see here, just a few days ago, they've got quarterly earnings here of 60 cents per share, which was higher than the consensus estimate. So this is a good upside of around about a third over what people were expecting would happen. In fact, Yahoo, if we have a look at the statistics, the forward P ratio is 31, so that is quite high. The price to book is around about half. So if you look at the assets minus liabilities of the company, is a value X, and the value of the company is half of that in the market at the moment. So this suggests there could be a little bit of upside on the basis of the book value. If you have a look at the analyst estimates, first of all, on the right-hand side, you can see a few people saying buy, half of the people saying buy, analysts rather, and then half saying hold. No one's really saying sell. And the suggestion here for the next year, look at the growth estimates, very negative. But for the current year, essentially 300%. So I think there is probably a short-term upside if analysts are correct. But in the longer term, they're not going to absolutely start smashing out higher earnings. That leads me to one final point from Seek Alpha, which is their structure. Have a look here. A couple of years ago, they did change their structure, which is quite complex on the left. They simplified it to the right. And what we see is there's actually a midstream company as part of their group. It looks like the midstream company actually provides quite a lot of the earnings or cash. So look at the midstream company, you can see that the parent company owns around about 30% of them. It's the same CEO, much larger salary on this company, and the dividend yield is 10%. So obviously sending money up the line, this high dividend yield. Okay, so the final thing is this a company to buy before even thinking about going through this valuation calculator for free cash flow on Buffett's books? I think my summary is that it looks like a normal sort of oil and gas company. I can't say it's definitely better than what's in my portfolio from my personal perspective. I can't speak for your portfolio, so I'm not a financial advisor. I don't know your individual circumstances, so you should do your own research and not just rely on this. Make your own choices. There is perhaps some short-term upside. If the oil price goes up a little bit more, look at the book value, it appears that there's probably upside for this company. But I think it's quite hard to say how it's going to trade over the long term. Will it ever get back to that 65 or even near it that it had many years ago? If we go back to the chart, have we actually missed the run up from around about $1 up to 9 as the oil price has risen compared to a year ago? Have we missed that point? I've actually got exposure in my portfolio to Shell, for example, and BP Midstream Partners. So I wouldn't buy these in addition to those. I'd probably be a bit heavy in that sector. So for the £1 million challenge, and I'll drop in a link to that challenge if you'd like to hear more about that. It's my long-term 20, 30-year challenge. This won't be making the portfolio. I could see why someone would want to buy it in terms of the discount to book value and the potential short-term upside, but I don't see this as a Warren Buffett type stock where you're saying, would I be happy to hold this for 10 years if the market was closed, then look at it in 10 years' time? I don't know if I would be on this one. So I don't see it as a long-term hold. For those of you out there that disagree with me, which I could definitely be wrong, I may not know this company as well as some of you, I will calculate what I think the value would be, just for comparative purposes. If we go to the discounted cash flow calculator, I think we said 1 billion was the free cash flow earlier. Right, so let's say with this billion of free cash flow, which we can see here, let's say that doesn't grow over the next 10 years, and we use a 10% discount rate, and then a 2% kind of perpetuity rate after that. There are 302 million shares outstanding. And then it's trading for 9 on the stock exchange, and we run these numbers, and it comes out at an intrinsic value based on the cash generated being discounted over time of $35, based on the cash it generates and based on the book value calculation. There is, yeah, it could definitely be a buy for some portfolios. I can see that. Not a buy for me. I can see why someone would want to buy it. So I'm very exposed in that sector already. In fact, not only do I have Shell and BP midstream pumps, I've got Diamondback Energy as well. So I hope you found that useful. Let me know in the comments below you think the true underlying value of this company is, and if you've got any requests for what you'd like to have me look at next. So thanks for joining me on this one, and I very much look forward to seeing you next time.